So we've grown at 28% in the last quarter, and if you look at the last 5 years, we're still below, about 40% below, 35% below the peak. We're also below the 12-13 levels. So to answer your question, I mean, I just still feel the achhe din are yet to come, and our company is still about 70% of our capacity. We are working on 70% of our capacity. So we are ready, and if the market grows as it should, with all the infrastructure projects, the CV market grows, we expect better results next year.
All right. So to that, Mr. Johar, and congratulations on what looks like a good set of numbers already, though, like you said, by your own admission, you're off the peak. But, it's 8.7% for this quarter. Your margins look very good as well. But for FY16, it's just a tad above the 6% mark. So what's the kind of upside do you have? I mean, what were the kind of margins you were doing at your peak? And how much higher do you think they could be scaled up in FY16?
Okay, so, we are still being conservative in our going forward. We are taking a growth of about 10%. We feel the market should grow about 10 to 12%. Our top line will grow more than 12% because we expect to increase market share and add new products. And the bottom line should be more than the top line. So we expect a good year actually going forward because besides leaf springs, we are also adding new products. And the content per vehicle is going up from like 20,000 rupees by about 30 to 40% higher. And these new products are very exciting. They are new technology products. So we expect a good set of numbers next year. And I want to add a couple of other things what we've done. We've done, our team's done an excellent job on cost reduction. We've reduced our costs through making our balance sheet very lean. We've reduced our current assets, our debtors, our inventories have gone down. We also have added new high value added products and all the low value, low contribution products are something which we've kind of taken off our order books. So going forward with a lean company, expecting a better growth with mining starting and all the infrastructure projects starting, we expect exciting next 2 to 3 years.
Give us a sense, what kind of margins at the operating level is the company targeting?
I think we should be happy with double-digit PBT numbers. That's what we are focusing going forward.
What was it in FY15, just to get a comparison?
I think our PBT in FY15 should be about 6 to 7%, and with the finance costs going down, we expect a much better numbers.
So your interest costs have also come down this quarter to about that 4 crore mark. Can you tell us what are the kind of steps that you've been taking to reduce your debt, and what does your debt stand at right now?
Okay, so the debt figure today is 60 crores. And if you look at last 2 years, from 180 crores, we went down to 120, and now it's 60. So there's been a substantial reduction of debt. And like I told you, we've done a couple of things. We've been, we've not expanded. We've not done much capital expenditure. In fact, last 2 years, our capital expenditure has been less than our depreciation. So that's been good for added to the balance sheet. Number 2, we've become, like I said earlier, very lean. Our current assets have dropped substantially. Even though our top line grew at 28%, we've reduced our current assets. So our debtors have gone down, our inventories have gone down, and then we also sold our non-core assets. We had a joint venture where we kind of sold our stake in that, and that's been plowed back into the company. So even though I feel that we are still below 35% below the peak, and we've still been able to reduce our debt. So once the market does pick up, we feel it's going to be very exciting.
Do you still have any non-core assets that you could sell? And if yes, what would be the value?
I don't think so. We do have, but I don't think we have any plans of selling them because we are very comfortable as far as, financially. I don't think the company needs to be concerned of any other. We are very comfortable with this kind of debt at our balance sheet.
Okay. Recently, you also... Sorry, you want to add something?
Yeah, no, I was just going to say that going forward this year we are also adding a new plant in Hosur near Bangalore, and this is going to be for our future where we want to diversify our markets. So we are focusing on three things. If you look at our company, we are diversifying our products, which I talked about in the beginning. We are also diversifying our markets. Right now we are pretty much a OE-centric company, but in the last couple of years we are increasing our share in aftermarket, exports and OE exports. So we are putting up a state-of-the-art, world-class facility in Hosur, and this is what we are going to be focusing on exports. And I think our total investment would be about 100 crores in Hosur plant. And we are really excited about this facility because this would help the company go and capture the export markets.
So how much does exports contribute currently to your top line, and how much higher could it be post this Hosur plant coming online?
Good question. It all depends on how the Indian market grows. But we would be very happy if our non-OE business is about 30% of our total sales, and today it should be less than 10. So that includes aftermarket India, aftermarket exports and OE exports, and that's what our target would be.
Would the margins in the non-OE business be much higher than the OE business? Just, can you walk us through the reason for the company focusing on that, and also if you could tell us what the margins are in the two types of businesses?
Okay, there are a couple of reasons. A, we want to, obviously we're focusing on reducing our break-even point, and we want to see the industry very cyclic. So what happens that when the commercial vehicle industry does drop, the OE business, the aftermarket business, the aftermarket exports business is pretty stable. So that kind of helps us through the cyclic industry. That's one reason. Number two, like you correctly said, the margins are much higher. It's an easier product to manufacture because they are sold not as assemblies but as loose leaves. So it's an excellent strategy for us to reduce our break-even point, build a moat around the company, and we really want to focus on new markets, new products to make it a more solid company.
Okay, Mr. George, just one final question from my end then. You sound pretty optimistic about FY16 onwards. You're setting up a new plant, while that could be primarily focused on exports. But, from the kind of discussions that you have with your clients, can we sort of infer from your optimism that the CV recovery could be imminent rather than, delayed much longer?
I personally feel that it's not going to be that quick, the CV recovery. That's why, like I said, this year we've only taken a growth of about 10%, 10 to 12%, and we are still 35% below the peak. So, but I feel, once these infrastructure project kicks in, now your guess is as good as mine, if the coal mining starts and the iron ore starts and we start building roads, then we can go back to our peak. And personally, I see some revival happening in October, November, and then next year I feel 16, 17 would be an excellent year.